Hi, I'm Richard Vague with Tychos. In today's analysis, we're going to compare the performance of China and the United States stock markets over the past 5 years to hopefully unearth insights relevant to both economists and market analysts. First, let's take a look at the stock market performance of China and the U.S. Over the past 5 years, the U.S. stock market surged 88%, while China's experienced fluctuations, ultimately resulting in a 13% decline over the same period. By the traditional measure of the price-earnings ratio, as of 3/13/24 in the U.S., the S&P 500 PE was 23, while in China, the CSI 300 price-earnings ratio was a much lower 13. Now let's look at that a different way. Over that same period, the ratio of China's public stock market valuation to GDP has gone from 68% to 61%, while in the U.S. it has gone from 169% to 209%. Now, that's not the whole picture, since many companies are privately held. U.S. public companies comprise half of total business value, while in China, it appears public companies comprise only about 20% of total business value. From a pure valuation standpoint, more of the business world is public in the U.S. than in China. Now, the aggregate value of private companies within a country is a hard number to extract, much less have confidence in. But if we take the best estimates of that and then add to it the total value of public companies, we get an estimate of the total value of businesses within a country. And that number is similar at the moment between the two countries. For 2023, a reasonable estimate for that in the U.S. is 288% of GDP, and in China it is 272%, or about 6% smaller than in the U.S. And not surprisingly, the size of the business sector as measured by top-line revenue, i.e. gross value add, is similar. 67% of GDP in the U.S. and slightly smaller at 62% of GDP in China. But if we dig down further, there are two profound differences in the business sectors of the two countries that are little discussed. First and foremost, the cash earnings in China's businesses are far worse than the U.S. or any major country for that matter. In the U.S., aggregate cash earnings were a positive 1% of GDP in 2023, while in China it was negative 10% in 2021 and negative 8 to 12% for the 5 years prior to that. That's an astonishing fact that we derive from OECD and S&P data. Years ago, that extraordinary difference could be rationalized as companies investing in the future, but lately we can readily see that a lot of that is spending on things like building real estate that ends up empty or even torn down. It is overproduction and overbuilding that has been happening on a massive scale for years. The second big difference is leverage. In the U.S., non-financial business debt to GDP in 2023 was 83%, while in China it was twice that at 166% of GDP. That's a massive difference that means China's businesses are buried under debt. These two factors were central to the recent crises at companies like Evergrande and Country Garden, but in a larger sense, they showcase the pervasive economic challenges that China faces, essential for understanding China's business environment and economy as a whole. If you factor in these two differences, you might very well conclude that China's total business value is overstated, and that as part of that, China's stock market is overvalued. At even a cursory level, it is easy to speculate that the value of assets carried by many businesses are in fact overvalued. In any event, it at least argues for a much deeper analysis. One more thing. Constructing this analysis was challenging due to elusive facts and data and relied on a number of assumptions. So if you have any additional information or a different perspective, we would welcome it. That's it for this week. Thanks.